Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our August monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. It was great to see we had over 100 in attendance a couple of weeks ago at our quarterly investment forum at Perry's. A little bit late for the third quarter. The fourth quarter, by the way, you'll be getting notice about that soon. Will be on Wednesday, October 21st. We look forward to seeing many of you there. So we're going to continue a frame in honor of John Mark. We mentioned this in the May monthly market update if you want to go and check that out, with describing the market and the things that are impacting the economy and financial markets with mirth and woe. Mirth being the good stuff that are supportive of markets, and woe meaning the bad stuff or headwinds, things that are working against markets. So as we summarize the comments today, we'll kind of summarize it with that frame of mind. So a lot going on. We'll kind of jump right in. So if we were having this, this conversation in March, the geopolitical risk was high. Markets were trading, really singularly focusing on geopolitical risk. And while the conflict remains in the Middle East, the geopolitical risk from a market standpoint, meaning markets are higher than they were in early March, the geopolitical risk is lower. Now, there's some big ifs associated with that geopolitical risk being lower. It means some version of these better outcomes are more likely than not, that there's some version of a ceasefire, a deal, the strait more open than closed, et cetera. But at least at present, the markets are pricing in lower geopolitical risk, which really means there's this ongoing tension between this geopolitical instability and earnings growth, which we'll talk about next. You can't talk about earnings without talking about the largest market cap company, over 5 trillion in market cap, NVIDIA, that posted last night, with a description you can only describe as wow. Says the demand for their chips are even getting hotter. 70% revenue growth are what is forecast. So this is an example of what we'll talk about in a second of not only a beat, but a projection that's better. Overall, another interesting dynamic that's happening in markets is even though markets are up, the price has improved. And that's because earnings have been so strong. So if we look at a year ago ending July 31st, PE on tech stocks as an example have actually gone down, even though the price has gone up. So again, it's kind of a trick question. We ask it in the forum: are stocks cheaper now than they were in January? The answer is yes, because while price is up, earnings are up even more. And this is just kind of where earnings estimates have been. 86% are beats, 10% are misses. Obviously, this is 8 or 9 to 1. Beats versus misses are very supportive. And as it relates to projections, 64 companies have already guided above consensus for Q3, which is near historic highs. So again, not only are they beating, but they're projecting higher. Now, the market has expanded in terms of what's winning in terms of earnings growth, but you see share of market cap, AI-related companies, 48%, but they're still contributing over 2/3 of earnings growth. The second, which is energy, some of that due to geopolitical risk, is contributing 20% to earnings growth, and financials 13%. What's interesting about earnings growth as it relates to lack thereof is that 42% of market cap companies are only contributing 2% to forward earnings growth. So again, you're still seeing a narrow part of the market with AI, energy, and financials contributing most of earnings growth for Q2. And this is just kind of a reminder of this being a different market than the dot-com bubble that burst. The tech bubble had 80% earnings growth, and the stock returns were some 6x greater than that. With AI-related companies today, earnings growth and stock returns are about a match. So again, at this point, it doesn't mean this will be this way forever, but at this point, earnings are supporting price movement. And this is kind of a summary of where we are on earnings, that more companies are both beating and raising than missing and lowering. So as long as that continues and as long as earnings focus remain the focus of the market, and not geopolitical risk. And again, this could change tomorrow. But right now, more stocks are on the beat and raise side than the miss and lower side, and that's supportive of financial markets. So other thing the markets are paying attention to, the Fed will kind of go through the dual mandate of full employment and price stability. First with jobs, a contraction of jobs in July. What's interesting about that is not only the parts of the jobs market that came from, but that the markets actually responded positively to the negative jobs number. And some perspective there is that likely meant the Fed was less likely to raise rates in the back half of the year. So markets actually took a negative jobs print as a positive. And this is just kind of a restatement of that. Again, this weaker jobs number has reduced the immediate pressure on the Fed to raise interest rates. So that's kind of a good news, bad news scenario. The most recent CPI, it continues a little bit soft. Last month it was negative. This month it was 0.1. So headline inflation 3.4, core at 2.5. So again, still heading in the right direction, softening, but still well above the Fed's target. So how are consumers feeling? What's interesting is sentiment is at an all-time low. What's interesting about that is that at previous cycles, when sentiment is at a low, it's a contraindicator for stocks and their 1 year returns after low sentiment. Now, one of the reasons you may have this sentiment difference is kind of what we talk about, the K economy, where asset owners are on the top and non-asset owners are at the bottom, and the fact that things, including houses, have gotten a lot more expensive. This goes back just a decade, reflecting both a lower price of homes or housing and lower interest rates. And you'll see that the average, the median monthly market or the median monthly mortgage payment is up some 160% in the past decade, which is nowhere near where incomes are on a percentage basis. So just one component part of where sentiment is with housing, that housing has gotten a lot more expensive over the last decade. Some of that is supply of housing. A lot of that is due to rates being a lot more expensive, the cost of money being a lot more expensive now than 10 years ago. That being said, consumers are still spending pretty aggressively. So consumer spending, while sentiment is down, spending is still expanding 4 to 5%, record highs on online retail and services. So right now, the soft data of sentiment is not really finding its way into hard data of spending. So midterm elections coming up, this just speaks to this period of time that we're in the midterm is typically a lower average return than in other parts of the election cycle. However, the better quarter or the best quarter in a midterm election year tends to be Q4, which is right around the corner from us. So other things to keep an eye on, the 30-year bond rate is now at the highest rate in a decade. So while the Fed is not raising rates, at least at this point, the bond market is flashing some concerns and pricing now above 5%, which again is the highest point that it's been in a decade. So where are we in the current bull market that started in October of 22? We're here up 111%. Where does this compare to the average bull market? Almost double that. And in terms of years, 5.6 years versus 44 months now. So compared to historical bull markets on a price basis and a length basis, we're kind of midway through. If we think about economic expansion, a little bit different story. If we go back 100 years, the average expansion is 61 months, and we're at month 73. So 100 years of economies expanding and contracting, we're kind of above average. However, if you go back over the last since 1982, so the roughly 40 plus years, the average expansion has been longer at 104 months. So, depending on how you view the current expansion in the context of 100 years or since 1982, we're either kind of above average on expansion, or again, looking at since 1982, we're only in about the sixth inning. So as it kind of summarizes, again, mirth and woe of markets, we'll talk about those next, mirth being good stuff and woe being bad stuff. And we continue to say some of the same themes, although some of these have changed slightly since our last monthly market update. But the continued mirth or good stuff or tailwinds in the market, our oil prices fall and inflation cools. We are seeing some signs of both of those. AI supercharges productivity and profits remain strong. We spent a lot of time talking about earnings, which have just been very, very good. And so the best bull case is lower inflation and AI-driven demand and ultimately earnings. Kind of the headwind, the woe, what could go wrong? Higher interest rates. Again, we are seeing the 30-year trading at a 10-year high. That's worth keeping an eye on. The consumers weaken. So what you find in soft data with sentiment finds its way over to a weakened consumer that stops spending, and that we eventually get an AI spending slowdown. Again, no sign of that with NVIDIA chip projected demand from the earnings call yesterday. But that's something to keep an eye on. We will be rebalancing our target allocations over the next few weeks. Look for trade notes in front of that. And if you have any questions, reach out. So feel free to contact us if you have any questions. We're here to serve you. Again, we hope to see many of you at our next forum in October. If we can help you out in any way, please reach out. Again, we're here to serve you. Thank you again for the trust and confidence that you place in us. We hope you enjoy the rest of your summer. Be well and take care.